So Alex and I met this morning for the first time, and he came on our show. We had a little chat. It was really good. And tell everybody, what do you do?
Sure. So I work with a group called FundersClub. We are the world's first online venture capital firm. And I found some common themes actually with our last speaker in the sense that we were taking on an industry that really hasn't changed in decades. And do we have any founders in the audience who've raised capital before? Was it an enjoyable process? Yeah. So it's just incredible. But the entire financial underpinnings of growth of the innovation economy is decades old, even though it's what's fueling such innovation. And we realized that and set out to say, what would venture investing look like if it was invented in 2013, if it was approached from a user experience point of view? What do people really want, and how do we make there be less friction in this experience? Yeah.
You know, I've started a couple companies in over 30 years, and we didn't know what raising capital was all about. Like, we had no idea that there was supposed to be a process. It's only the last couple of years I learned that there's actually a process that you're supposed to follow. I thought you just go out and kind of keep bugging people until they give you as many millions of dollars as you need. I didn't know there was actually a process. What you guys have done right now is in a certain way, you've kind of stepped in front of it. I don't necessarily know if I like the term demystified it, but you've changed a little bit. You've commoditized it for small companies, because we probably get, on average, a couple of hundred emails a year that say, hey, I got a great idea. How do I get started? Or what do I do once I've just at least validated concept?
Sure. And I mean, that touches on one of the key problems we saw that exists today, which is for the best founders, if you're out raising capital, what are you not doing, right? You're not talking to your users or your customers. You're not building product or services. And fundraising itself becomes this huge process, this huge effort. And it is a process, and we really wanted to kind of, like you said, demystify that, make it more efficient, and I mean, to really break it down and make it real for you, to give you a sense of what it's like to fundraise for those who don't know, for a small company, while you're just barely keeping your head above water as it is, right? So just barely able to cover your costs, and you know this from your experience. You're also going to meet with groups of, for example, angel groups or pitching to VC firms, where you're sitting in a room, you're asked a bunch of questions, they say thank you very much, you go back to your thing, you do about 20 of those meetings, you go back and forth for a couple weeks, sometimes a couple months over emails, maybe you're demoted to an associate, and then you have a little side conversation, and finally you get all these checks together, and if you're lucky, you're able to wrap that up, close your round, and keep going. And clearly that's not how founders would design the experience. And so and I had insight into this. Basically, I've started a couple companies, and in the process raised $30 million of venture capital and angel capital for my own companies, and really opened my eyes to what the good and the bad that was out there.
There was a takeaway this morning when Alex and I were talking. There was a takeaway because I guess to a certain extent I'm an investor. I'm an angel investor. So, but a lot of people come to me and they say, "Will you invest in the company?" They hand me some kind of a deck, and they say, "Hey, Tom, take a look. This is a great idea." And I know I want to invest in this person. I really like their idea, but I always end the same way, which is, I'll invest X if you get to a certain number. It's an old trader thing. Like, if you can get half the order filled, I'll take the next 10%.
Founders clearly hate that because they're...
Of course, right. But I don't know how else to vet a deal on my own. And so I think what you guys do is you make that process, you almost do a lot of that vetting work for us.
Right, so what I've spoken to so far is from the founder point of view, but actually as an investor. So I went on to become a startup investor, as did my co-founder, Boris Silver. He was a successful entrepreneur, got an acquisition early on, became an angel investor, and his core initial issue was just knowing what to invest in and understanding how to do the due diligence on these opportunities can be quite complicated. And what's quite shocking is, in this country today, there are 10 million what are called accredited investors, 10 million. And these are people who have high net worths, and they're legally allowed to invest in startups. Actually, another kind of ridiculous circumstance of the country today is, if you're not high net worth, if you're not a millionaire earning a high income, you can't legally invest in startups, but that's for another panel, another topic. So these 10 million people, of the 10 million people, only 250,000 of them, so something like 5% invest in startups today. And the reasons for that are partly because of what you're talking about. And so what we're trying to do is increase the level of transparency, lower the bar for being able to review opportunities, understand, and to your point, being able to have sort of a group vetting process, and that's not reliant just on your own ability to vet a deal, but that pulls in experts from the startups industry, from the startup world, from the investing world.
Well, I also think as an investor, one of the neat things about what you do is, like for me, if I want to invest in a lot of early stage or mid stage companies, I have to go to a private equity firm, which means I have to select a private equity firm, and then I have to trust their selections down the road. I think what I've always wanted to do is make my own decision. I think this needs to come back to the do-it-yourselfer. I'm a do-it-yourselfer, and then from making my own decision at that point, go forward and make a decision. And I can do that through your site to, like, what's the minimum, maximum type thing? As an accredited investor.
Well, first of all, addressing what you're saying is because I think it'd be of interest to the audience.
Sure.
The industry, the venture capital industry as a whole, this is quite a humbling fact, but on average, the VC funds don't return capital to their investors, to their LPs, so to folks like you.
Are you allowed to say that?
I'm happy to share the facts. So, and because of that, clearly, like, they're being paid, they're collecting their fees supposedly to manage your capital, and so a lot of people are actually asking, like, hey, if I'm paying folks to manage my capital and they're just not making a return on my capital, maybe I should just deploy it myself. Sort of in the way that there are investors who do pick certain strategies, a certain ETF, certain mutual funds following a certain strategy, or even specific stocks on the public markets. And so we do make that possible. And to your question about check size, that's actually a very dramatic difference as well. So another reason why there are so few angel investors or investors who invest in startups as individuals today is because the minimums to invest are really, really high. So it's like $25,000, $50,000, $100,000 at the seed stage, so at the earliest stage of a company's fundraising cycle. And if you're, even if you're making a couple $100,000 a year, so if you're doing very well, putting 50K in one company in 1 year is probably not a sound, like, logical, financial, diversified, portfolio strategy. So there really wasn't a way to do that, and so we really were like, how can we slice and dice that so that there's an entity, in this case it's FundersClub, that can be the investor who's deploying a large amount of capital, but where individuals can provide and sort of that capital as individual investors at a check size that makes sense for them. So as little as $2,500, $5,000 at a time.
You see so many companies. I think you told me this morning that since you guys launched your product, you've invested in 50 or 60 companies?
51.
51 companies.
Right.
And that's only since last summer.
Right.
Talk to us about some of the deals that you've seen at early stages that make this whole exercise really exciting for you.
Sure. I mean, yeah. The reason we created this in the first place is we truly believe that there is so much potential out there in the world for people to get involved in entrepreneurship and to start new things. But because of what I just described, like, there really isn't as much capital out there to support those efforts as there could be. And so the number I gave earlier is that only 5% of people who could invest in startups are. If you extrapolate out how much capital there could be available to entrepreneurs to try new ideas, to test new markets, it would be over $500 billion just in the United States a year. The entire venture capital and angel industry today deploys about $50 billion. So we're talking about a pool of capital that's 10 times bigger potentially available that allows for new ideas. So, and anyways, so for us, like, we're just starting to see that. And so the kinds of ideas we're bringing to light, obviously we don't pick favorites, they're all wonderful, but just some of the more interesting to describe ideas. I mean, there's a company called Thalmic Labs that they're revolutionizing gesture, motion, and input. So you may know, like, the Microsoft Kinect, where you move your hands, or the Wii, mm-hmm. And I'm sure you're all familiar with touch screens and mice and keyboards. They've created a device that is a bracelet you wear here, and it reads your muscle signals. So it knows, actually, even before your hand moves, what you're going to do with your fingers. And so they're doing things like creating keyboardless keyboards, input devices where you snap to make the music turn louder, things like that. We funded a company that makes an electronic skateboard. Goes uphill, goes 20 miles per hour.
That's what I need.
Right.
With a seat.
Riding around looking like that, So yeah, and from those kinds of ideas to as boring but as impactful as making accounting more understandable for small and medium businesses. So we funded a company called Indinero that automates the process of, it sort of plugs into all of your banking systems, your checking account, your savings account, et cetera. And rather than having to know how to do accounting and work with QuickBooks, it just gives you your updated P&L live and so forth, and balance sheet, and
we have this
everything in between.
We have this theory, Alex, that in order to change and transition an industry, you have to be, one, transparent, and two, you have to make your products available to a lot more people. It sounds to me, I have this idea that American investors, consumers investors, even accredited investors, have this incredible strive towards mediocrity. We're happy with average because we didn't lose. And it supports everything you've said about just the returns. The question is what you're doing going to change that entire approach to investing in startups? You know, whereas it's not necessarily, hey, I'm just doing this place some good, or I'm just taking a free shot, to when it's a real piece of asset management.
I truly think so. I mean, one of on the check size front, I mean, just to explain that, when you used to be deploying 50K in one go, that truly is a gamble. It's a bet, right? Whereas what we're saying is, hey, like still pick and choose, but diversify. You know, spread across, just like professional venture investors have portfolios. You should probably do the same thing. It's probably not responsible to just gamble. If you're doing that, you're literally gambling. It's just for fun. But once you start to enable diversification, you're able to mitigate risk. And clearly, you know, we're not proposing that people say pour their life savings into the startup asset category. The startup asset category is a high risk, high reward type of category. And because of that, it's more for portfolio diversification.
Define high risk.
So you could lose all of your money.
No, I know, but define what's a realistic, we know that, but define a realistic, what's a realistic, you know, assumption? Like, where are you going in with 10%, 20%, not return-wise, but statistical chance of?
Well, I mean, like, just being frank, every year there are at least 4,000 startups in the United States seeking capital, and there is no way that all 4,000 like necessarily merit that capital, at least at that point in time. So as an investor, you have to be very careful of where you're putting your money to work. The aggregate trends say something as few as like 1 in 10 of just everybody out there will eventually still be there 10 years later. And some people say the number's less, some people say it's more, but it's something like that. It's a fraction. It's not like over half of businesses that stick around.
Is this the new frontier? So when I got to Chicago, like 1980, the new frontier was all the markets exploding because we had all this derivative marketplace here in Chicago, and that was the new frontier. That's kind of where all the cowboys went. Yeah. Now, is this the new frontier? Is the new frontier startups being able to acquire capital and, you know, and making it more mechanical than it's been, let's say, the last 4 or 5 years?
Sure. I mean, in this dialogue, since we're talking about money, the Benjamins and stuff, I should take a step back and point out that my first advice to entrepreneurs is don't raise money if you don't have to, and also like stay scrappy as long as you can, and sort of get product market fit, you know, before you really go out there. So as we're talking, I'm like, sheesh,
It's so funny you say that, because my advice is exactly the opposite, which is take as much money as you can get if anybody's willing to give it to you. Because when you need money, you can't get it.
What? You didn't okay. Yeah.
When you need money, you can't get it. But when you don't need money, everybody wants to give you money.
Yeah.
That's all right. That was
you should have taken Plain Guy's money.
Yeah, you should always take the money.
Sorry,
I messed them up. Sorry about that.
Yeah.
No, I was talking about this is kind of a new frontier.
The way I think it's the new frontier is it's not like, hey, it's the Wild West, everybody raise money and let's fund everything. It's bringing the concept of startup investing more mainstream, creating more of a dialogue around, hey, look, like there are people here trying to change the system, disrupting different industries, and you're bringing 10 million people in the United States alone who've never been able to invest to be able to. And how many of those do, well, it remains to be seen, but clearly it's raising the profile around this entire group of companies. And so I think that's what's impactful.
The individual investor doesn't have an opportunity anymore to really invest in companies when they're first starting out, like Twitter or Facebook or these companies. Whereas when we were kind of growing up in that same era, we could invest in Apple on their IPO.
An IPO used to mean that a company is sort of super high promise, high growth. It's maybe like a $500 million market cap. Now Facebook, you know, IPOing recently at high double-digit billions. That's would have been unheard of 10 years ago. So the macroeconomic changes that have occurred are also creating this pressure from regular investors who used to be able to participate in that innovation and value creation on the public markets, and they're seeking, there really aren't many other mechanisms to participate in what they used to be able to. So that's totally the case.
Alex built an incredible little company, and it's an awesome site. It's FundersClub.com. You should check it out. Thank you, Alex Mittal.
Thanks.